Imagine you're sweating, right? You're leaning over this glowing arcade cabinet, playing a fiercely competitive multiplayer fighting game.
Oh, yeah, just mashing buttons.
Exactly. Just
Yeah.
frantically mashing buttons, throwing punches, trying to survive the round. But the player sitting directly across from you,
They're not even looking at the screen.
right, they aren't looking at the characters. They're looking straight into the game's source code. I mean, they can see every single move you're going to make a split second before your finger even hits the button.
Which means they aren't playing the game anymore.
No, they're playing you.
And if you don't realize that the rules have shifted completely like that, well, you're going to lose every single time. It is a brutal realization.
It really is brutal. And that invisible, predatory game is exactly what we are decoding today. Welcome to today's deep dive. We are tearing through a fascinating stack of sources to uncover the plumbing beneath the casino floor of the financial markets.
It's quite the stack today.
Yeah, we've got the documentary diaries of a legendary anonymous Japanese day trader named CIS. We're also tracking the digital footprints of institutional market makers using these intense technical trading guides on things like fair value gaps and order blocks.
Really technical stuff.
Very technical. And then we're zooming all the way out. We're layering in a masterclass on macroeconomic cycles and live Bitcoin charts to see the sheer scale of the board we're actually playing on.
It's an incredibly ambitious cross-section of info. I mean, we are going to start by looking at the raw psychology of just a single trader, then zoom into the microscopic traps set by algorithms, and finally pull back to examine those towering macroeconomic tides that basically dictate the value of everything we own.
Okay, let's unpack this, because before we look at any complex charts or global economies or central banks, we have to understand the human element.
Always starts with the humans.
Right. Stripped of all the jargon, markets are fundamentally multiplayer games driven by raw human psychology. And there is absolutely no better case study for this than that Japanese day trader known simply as CIS.
His origin story is, well, it's incredibly revealing. Because he grew up in 1979, right in the middle of Japan's massive economic boom. But his foundational lesson in market dynamics, it didn't come from a textbook.
No, it came from a kindergarten snack store.
Oh,
Love this detail. He and his friend, they were tired of constantly losing this local lottery game.
Oh, the odds were totally against them.
Completely. So CIS figured out a workaround. Instead of buying single tickets and just, relying on blind luck, they pooled their money and bought the entire physical box of tickets from the owner.
Which mechanically guaranteed that the winning ticket was in their possession.
Yes.
I mean, without knowing any academic terminology at all, a kindergartner discovered the universal laws of expected value and pattern recognition. He realized if you play by the house's rules, you lose.
You have to buy the system.
Exactly.
But his home life was, it was the opposite of empowering. He had these really strict, abusive parents who were constantly pushing him toward academics, which he entirely rejected.
Yeah, he hated it.
So he escapes into the arcades of Tokyo, playing competitive fighter games. And this is actually where he coined the name CIS, which literally translates to death in Japanese.
What's fascinating here is that the arcade environment provided his true financial education. I mean, in those fighting games, he realized really early on that emotional instability...
Like getting angry when someone taunts you.
Exactly, what gamers call going on tilt.
Yeah.
That always led to a swift defeat. To survive, let alone win, he had to think fast and remain just entirely unnervingly calm.
And he even carried that clinical mindset into online gaming later on, right? Like playing Ultima Online.
Yeah, but he didn't even call it a game. He hilariously referred to it as building and protecting assets.
That's so telling. So eventually he takes $30,000 that he managed to save from his soul-crushing 9-to-5 engineering job, and he steps into the real stock market.
And he just goes on an absolute tear.
An unbelievable tear. He turns $3 million into $30 million in a single year, mostly by just ruthlessly cutting his losers and holding on to his winners.
But, the market always scales its lessons. It wasn't a straight line up for him. He lost $5 million during the 2006 live door shock.
Oh.
And then he took another $6 million hit in the 2008 Lehman Brothers crash.
And according to the sources, those staggering losses weren't even really about the global economy collapsing. It came down to two internal factors. First, falling victim to the gambler's fallacy.
Right, chasing the loss.
Yeah. And second, the sheer bloated size of his own portfolio. I mean, he got too big. His old, nimble day trading strategies just didn't work when he was moving that much capital.
But the guy adapts, which leads to his legendary 2015 Black Monday trade. He shorts the Nikkei 225 index.
Betting the whole Japanese market will fall.
Right, and then he flips to a long position at the absolute bottom and walks away with $33 million in profit in a single day.
Unbelievable.
The volume of his trade was so substantial, he literally moved the entire Japanese stock index by himself.
So he essentially became the final boss of the arcade.
He became the whale, yeah.
Which really makes me question the whole foundation of what trading actually is. Like, think about my video game analogy from earlier. Is CIS sitting in his pajamas deeply analyzing corporate earnings reports and supply chains?
No, not at all.
Or is he just playing the psychology of the unseen opponent on the other side of the screen?
It is entirely the latter, and he was very vocal about that. He explicitly abandoned company fundamentals incredibly early in his career.
Like, he didn't care about the product at all.
Didn't care about the product, didn't care about quarterly earnings. He treated the market strictly as a raw arena of human behavior. His biggest setbacks only happened when his own pride blinded him to the fact that his environment had changed.
Yeah.
He had to realize he wasn't trading a stock ticker. He was trading the fear, greed, and panic of other human beings.
So he survived because he stopped looking at the numbers and started looking at the emotions of the trader across from him.
Mm-hmm.
But if you're a retail trader today, logging on to some brokerage app, the person across from you isn't a guy in a Tokyo arcade.
No, not anymore.
It's a billion-dollar institutional algorithm, specifically programmed to hunt for your exact emotional breaking point. And to win today, you have to understand what these colossal institutions are hunting for.
And what they are relentlessly hunting for is liquidity.
Let's clearly define that, because it is the engine of everything we're discussing here. In trading, liquidity generally rests above previous market highs and below previous market lows.
Right.
Why? Because that is exactly where retail traders, the beginners reading the standard technical manuals, are universally taught to place their orders.
Let's break down the mechanics of that, because retail traders are taught a very basic, seemingly logical rule. If the price of an asset breaks above a previous high point, it means an uptrend is continuing.
So you should immediately buy.
Exactly. And conversely, if you're a short seller betting against the market, where do you put your safety net? You place your stop-loss order just above that exact same high point to protect yourself in case the price surges.
And a stop-loss on a short position is, mechanically speaking, a buy order.
Yes, it is.
So you have breakout traders placing buy orders and short sellers placing buy orders to cover their tracks. It creates this towering, invisible cluster of mandatory buying pressure resting right above a structural high.
And now, put yourself in the shoes of an institutional market maker. You have $1 billion of an asset that you need to sell. You can't just tap sell all on an app.
Because if you did,
your sell order would overwhelm the market completely. You'd instantly crash the price before your order even finished executing. You'd suffer severe slippage and basically ruin your average entry cost.
Right. So large institutions face this massive mechanical dilemma. To sell a staggering amount of an asset, they require an equally staggering amount of buyers waiting on the exact opposite side of the trade.
So they manufacture the buyers.
They engineer what's called a liquidity sweep. They deliberately use a chunk of their massive capital to push the market price up, piercing right through that previous high. Bam! The trap snaps shut.
All those resting retail orders get triggered simultaneously. The breakout traders aggressively jump in thinking it's a rally. The short sellers get violently stopped out. And suddenly you have this frantic pool of artificial buying pressure.
Here's where it gets really interesting. It's like a whale opening its massive mouth inside a dense school of fish. The market maker artificially creates the buying frenzy, quietly dumps their actual billion-dollar sell order into that frenzy at a premium price, and then violently reverses the market direction downward.
It is brilliantly ruthless.
It's insane. The market isn't just randomly reacting to news. It's actively mathematically engineered to trick beginners into providing exit liquidity for the professionals.
It sounds incredibly predatory, and for the retail trader, it certainly feels that way. But our sources emphasize that this isn't necessarily done out of pure malice.
It's just business.
Exactly. It's a strict mechanical necessity of a zero-sum game. To fill institutional-sized orders without destroying their own profit margins, they must seek out these dense pockets of liquidity.
And understanding that forces you to look at a price chart completely differently, doesn't it?
Yeah, you stop seeing arbitrary lines of value and you start seeing a topographical map of trapped human emotions.
So if the market is basically a giant mechanized trap designed to hunt your liquidity, how on earth do you protect yourself? I mean, how do you spot the whale before it opens its mouth?
You need a mechanical framework. You have to learn how to spot the exact, undeniable footprints that institutions leave behind when they manipulate the price.
Because they're too big to move without leaving tracks.
Precisely.
And our technical sources give us the exact tools to track them: ICT order blocks and fair value gaps.
So let's start with the order block. The golden rule here is top-down analysis. You look at the daily chart to see the big picture, then you zoom into the 1-hour chart.
You're hunting for the specific order block, which is defined as the last downward candlestick right before an aggressive, violent upward move that fundamentally breaks the market structure.
That specific block represents the institutional footprint. It's the exact moment they accumulated their massive position. But you don't chase the violent upward move.
Right. You wait.
Once you define the range of that order block, you wait patiently for the price to pull back into what the strategy calls a discount.
Meaning the lower 50% of that range.
Right. You buy there, where it's mathematically cheap, and you target the premium, which is the upper 50%, where that external liquidity, those retail stop losses, are resting.
And to confirm that you aren't just, catching a falling knife, you look for a fair value gap, or an FVG. An FVG happens when the price surges so incredibly fast that the opposing side, the sellers, have literally zero time to react.
The physics of the chart just break for a second.
Yeah, it leaves this towering, unbalanced candle, a literal vacuum in the price action.
But our technical sources are very clear here. A gap on a chart is not automatically a trading signal. There are 6 strict rules a fair value gap must follow to be considered a valid institutional sniper entry.
I don't want to just read a textbook list here, so let's think about why these rules exist. Rule 1 is that the gap must be unmitigated, meaning the price hasn't touched it yet.
Right, because if price already came back down and filled that vacuum, the whale's underlying orders are already gone. The trap is empty.
Okay, so Rule 2 requires the candle closing inside the gap to close in the direction of the trend, which simply proves the institutional momentum is actually holding.
Exactly. Rule 3 requires confluence. The gap must align perfectly with a previous established level of support or resistance.
Because an institution isn't going to initiate a billion-dollar reversal just floating in the middle of nowhere.
No, they execute at specific structural battlegrounds.
Makes sense. Rules 4 and 5 dictate priority and discount. This is where you use a grid tool. Think of it like throwing a measuring tape from the very bottom of the move to the very top to find the exact 50% midpoint.
And you only buy if the FVG is sitting in that absolute lowest priority zone, the discount area. You are mathematically demanding the cheapest possible entry price.
And finally, Rule 6. The gap must be formed following a clear break of market structure. It has to actually shift the broader trend, not just be a random blip.
If you want to visualize this, imagine a sprawling mountain range plotted on a graph, charting the weekly price of Bitcoin peaking around the $73,000 mark.
Okay.
The peaks and valleys aren't random. You can visually track the violent wicks where the price spikes up just enough to sweep the liquidity above a mountain peak, instantly leaves a massive unbalanced gap on the way down, and then violently corrects back into a discount order block hidden at the base of the valley.
Wow. But let me push back for a second here, because we are really deep in the weeds. We're throwing around terms like ICT order blocks, liquidity sweeps, unmitigated fair value gaps, slippage. Aren't all these intimidating terms just incredibly overcomplicated, fancy ways of describing basic supply and demand?
This raises an important question, and honestly, it's a critique you hear often in traditional finance circles. Ultimately, yes, every single market boils down to supply and demand.
Right.
But simply saying buy where there is demand is entirely too vague to actually trade on. These concepts act like a sniper's scope. They remove the emotional guesswork. By giving you a highly mechanical, repeatable checklist, it ensures you aren't just blindly guessing where the demand might be.
You are mathematically locating the precise coordinates where an institution was forced to act.
Exact.
Okay, so technical analysis gives you the exact timing, the microscopic entry points to avoid getting crushed by algorithms. But our masterclass source makes a terrifying point. If you do not understand the broader macroeconomic weather, your technicals will not save you.
No, they won't. You can have the best sniper scope in the world, but if you are standing on the deck of a sinking ship, you are still going down.
We have to zoom all the way out. We need to look at the macro board to understand what these assets are actually being priced against. And the core issue dictating everything right now is the systemic debasement of fiat currency.
It's the invisible thief.
Truly. Over time, governments issue debt, and central banks expand their balance sheets to buy assets, artificially suppressing yields. I mean, since 1971, when the U.S. completely decoupled the dollar from the gold standard, the actual purchasing power of the currency has plummeted.
We all know what inflation feels like at the grocery store.
Right. But simultaneously, the nominal price of desirable, scarce assets, prime real estate, blue chip stocks, fine art, has absolutely skyrocketed.
And this is where our sources draw a brilliant, absolutely crucial distinction between cycles and secular trends.
That's huge.
Most retail investors constantly confuse the two, which is exactly why they get chopped to pieces.
Let's break that down for everyone. Cycles are the short to medium-term rhythms of the economy. You have the 3 to 5 year debt refinancing cycles, when corporate debt rolls over at new interest rates, heavily altering market liquidity.
You've got the 4-year political election cycles.
The traditional boom and bust business cycles. And in the crypto space, the 4-year Bitcoin halving cycle. These cycles make asset prices violently oscillate up and down.
But secular trends are entirely different. They are long-term, virtually unstoppable macro directions.
Like the internet.
Exactly. The global adoption of the internet in the 90s and 2000s was a secular trend. The current rise and integration of artificial intelligence is a secular trend. And the constant mathematical devaluation of fiat currency by central banks is a secular trend.
I like to think of holding cash in a bank account like walking up a downward escalator. If you just stand still in fiat currency, the escalator is actively, constantly moving you backward into poverty.
That's a great way to put it.
To actually rise, to build generational wealth, you have to step onto the correct escalator. You have to buy assets that possess a strong secular upward trend.
If we connect this to the bigger picture, you have to look closely at the mechanics of central bank policies. Central banks generally engineer a target inflation rate, typically around 2%.
Which doesn't sound like much.
But over decades, that purposefully and methodically erodes your purchasing power. When central banks inject global liquidity into the system, when they expand their balance sheets, asset prices universally boom.
And when they pull that liquidity back to fight inflation, markets bust.
Right. And the profound tragedy of the financial system is that retail traders exhaust themselves trying to aggressively time these short-term cycles, while institutional wealth is built simply by taking a position in a long-term secular trend and just holding it.
So facing a globally broken fiat system where your money is actively melting, what is the ultimate asset people are turning to in order to escape that debasement? This brings us to the architecture of cryptocurrency, specifically the role of Bitcoin.
Our masterclass source defines Bitcoin not just as volatile digital money, but as a completely unique value proposition in human history. It functions as a decentralized, immutable cloud database.
And its supply is strictly mathematically capped at 21 million coins.
That fixed supply changes everything.
It does. There is no central issuer or CEO who can decide to print more to cover a bad quarter. It gets upgraded for free by a global network of open-source developers. It requires incredibly low maintenance compared to owning physical real estate where you have, property taxes and leaky roofs.
It's completely verifiably scarce. I mean, even physical gold isn't truly scarce. Humanity mines a little more of it out of the ground every single year as mining technology improves.
And the source makes a really profound comparison here. Bitcoin acts as a financial index for the world. Just like the S&P 500 indexes the economic output of corporate America, Bitcoin indexes the pure economic energy of millions of global users.
It stores their value without relying on corporate earnings, profit margins, or some board of directors.
But then we have to talk about the dark side of the space, the reality of altcoins. Essentially every other cryptocurrency that isn't Bitcoin. The market is flooded with layer 1 gas coins, stable coins, which are just fiat currency running on internet rails, and thousands of protocol tokens.
And this introduces a highly predatory hazard called the fully diluted valuation, or FDV, trap.
Oh, this is brutal.
It's a critical trap to understand if you are stepping into the crypto market. Many altcoins operate essentially like traditional venture capital equity, but without any of the regulatory safeguards.
Let me explain how ruthless this is for everyone listening. These projects launch with a tiny, artificially restricted fraction of their total token supply in circulation.
Barely any tokens available.
Right. Because the available supply is so low, a little bit of hype artificially pumps the price to the moon. But they have incredibly high programmed inflation rates baked into their underlying code.
So who gets all those new inflating tokens as they unlock?
The early insiders, the founders, and the venture capitalists. They quietly dump their inflating supply, their staking rewards, straight onto the retail investors who bought into the hype, entirely to fund their ongoing operations and secure their own profits.
It's a constant sell pressure.
So what does this all mean? Let me genuinely challenge the entire crypto ecosystem here, based on these sources. If Bitcoin is pure, scarce digital property, aren't the vast majority of these high-inflation altcoins just modern-day penny stocks? Are they just traditional pump-and-dump schemes wrapped up in confusing blockchain jargon, specifically designed to separate retail investors from their money?
It's a very fair, heavy critique, and honestly, the sources absolutely do not shy away from it. It is an impartial reality that many tokens use aggressive inflation schedules specifically to pay out their early investors.
Creating a highly dangerous trap for the uneducated buyer.
Exactly. However, the sources also point out that you cannot paint the entire multi-trillion-dollar industry with just one brush. The nuance matters.
Okay, how so?
Well, legitimate smart contract platforms like Ethereum, for example, operate much more like highly profitable, decentralized technology businesses.
Right, because Ethereum isn't just surviving on hype. It actually generates billions of dollars in real user fees from people utilizing the network.
Exactly. And they dynamically return those profits to the network's participants in two specific ways. They execute automated token burns, which mechanically is the exact same concept as a corporate stock buyback.
Permanently reducing the overall supply and increasing scarcity.
Right. And they offer real staking yields to people securing the network, which function very much like a traditional stock dividend.
Okay, I see.
So while your penny stock comparison is painfully accurate for a vast number of tokens, others are genuinely evolving into real cash-flowing digital economies.
Which brings the entire scope of this deep dive into sharp focus. We started in the neon-lit Tokyo arcades with CIS, learning that the market isn't about staring at numbers on a screen.
No, it's about outsmarting the emotional vulnerabilities of the player sitting across from you.
Yeah, and then we zoomed into the digital plumbing to see how institutional algorithms engineer traps with liquidity sweeps and how we can use fair value gaps to track their footprints.
And finally, we zoomed all the way out to watch the towering macroeconomic tides of fiat debasement actively force the world to seek shelter in hard, secular trends like Bitcoin.
It is a profoundly intricate ecosystem. Every single level, from the microscopic entries of a day trader to the macroscopic policy of a central bank, is entirely interconnected.
It really is.
The ultimate takeaway for you listening right now is this. In the financial markets, if you do not know exactly where the liquidity is, you are the liquidity. The whale is opening its mouth and you are the fish.
Unfortunately true.
But by thoroughly understanding both these microscopic institutional traps and the overarching macroeconomic secular trends, you actually stand a chance at protecting your time, your energy, and your purchasing power.
And that leaves us with one final fascinating thought to mull over today. But we spent all this time discussing just how chaotic, engineered, and predatory the trading game truly is. But consider this. If an asset like Bitcoin actually succeeds perfectly, if it genuinely becomes a singular, stable, globally adopted standard of value that fundamentally can never be debased by any central bank, does the entire chaotic game of day trading, liquidity hunting, and market speculation simply cease to exist?
Or is the human thrill of the gamble, that primal, deeply rooted need to outsmart the opponent sitting across the screen, so ingrained in our psychology that we will inevitably just build a brand new casino right on top of it?